So my name is Chris Lester, and I'm going to be your presenter and host today. Some of the folks on the call are my clients. Some folks maybe have seen an advertisement or a promotion on Facebook or LinkedIn, maybe an email blast. Maybe we've crossed paths in the past. Some folks on the call might be advisors, and maybe you're clients of some of the advisors on the call. Whoever or however you found me, I want to welcome you. And today's topic is afraid of missing the rally. So let's make sure my clicker works now. There we go. So that's my picture. So at least you can put a face to the voice. And if you have questions after we're done, something I've touched on, feel free to either email me, put a question in chat, and I'll see who it came from, and I'll do my best to get back to you with an answer, or maybe the advisor that invited you on the call. But again, welcome. The purpose and why I'm doing this is I want to just start to talk on different topics that I think are important and relevant in our everyday life, and share with you some of what I'm seeing and questions that we're hearing. So I'd like to start off with some good news. Whenever we're going to have conversations, I've always been an optimist. Let's look at the glass half full. There's a lot of things going on in the economy right now, and in the world, the global world in general, right? COVID-19, I'm on day 63 here in New Jersey, pretty much close to ground zero, if you want to consider New York City ground zero. And it's different in other parts of the country. But there is some good news. And first and foremost is, there seems to be indications that the curve is flattening. That has been the goal. And we're into the second week of May. And with that, we're starting to see less of people testing positive. But there is concern because we've also had some higher mortality, some of the highest yet, I think, last week. So we're not out of the woods yet. But again, I just like the knowledge of knowing that this too shall pass. The other good news is some states are opening businesses back up. New York is opening up tomorrow different areas of their state that they feel that will allow them to keep the engines running, right? So different parts of the country are taking steps depending on the severity that they have been dealt, right? So that is good news because we need to get the economy moving again. And the question is how to do so prudently. The summer months, so the weather is starting to warm. Here in the Northeast, a lot of the country is starting to experience warmer weather. And so that's going to help reduce the infection rate as well, right? People have become restless and they want to get out and they want to live their lives. They want to interact, and summer's upon us. And so, the states that have lifted some of the restrictions, even New Jersey with some of its public parks and things of that nature, as long as we're practicing social distancing, all good news for the economy. And this really is just, I think, a relief. I was very glad to see that our government come together in a time of need and put politics aside and really, for the most part, have been making great strides in a bipartisan economic stimulus and creating funds and money for the American population. I attribute a lot of that, right? So let's think about some of what they've done, right? So we'll talk about unemployment here shortly, but making unemployment funds available, right? So you have those funds. And then you have stimulus checks for those of you that were able to receive them, right? Those funds are available. And then for businesses, right, that have employees, right, to be able to get PPP loans and then quite possibly and probably forgiven, all really, really good news. And it will, and I think that it is that action that our government has taken that has helped to create the rally that we experienced in March. However, not everything is all roses. I don't know if any of you had the opportunity to watch Berkshire Hathaway's annual shareholders meeting about it wasn't this weekend, but the weekend before. But Warren Buffett, if you've not seen that, I would encourage you to Google that, right? Because there was quite a few sound bites. But one of the really important ones was somebody asked him the question is, Mr. Buffett, why have you not bought or have you not been buying? And his answer was pretty profound. And he stated, we have not done anything because we haven't seen anything that attractive. So to put this in context, right, for some of you, I would hope all of you have heard of Warren Buffett, right? But he is quite arguably one of the single greatest investors of our lifetime. Now, Warren Buffett, the reason since Berkshire Hathaway inception is, to my knowledge, the only investor to outperform the market by double. Like, his average return has been somewhere around 21% since inception. So, that's why when people say when Warren Buffett speaks, people listen. And people look is, what is Warren Buffett doing? Well, what you also have to understand, there's some interesting side information. Warren Buffett, Berkshire Hathaway, they had $120 billion in cash at the beginning of the year. During this market downturn, they actually have $137 billion in cash. They have been net sellers into the market, actually liquidating for their top holdings of airlines, right? And selling into this market. So from a purely observational standpoint, Warren in the 2008 financial crisis, when he sees value, had gotten creative and bought some convertible bonds and a lot of financial instruments back in 2007, right? He saw a lot of the writing on the wall then, and he will buy. But right now, what he's saying is we have not done anything because we haven't seen anything that attractive. Now, mind you, in the last 12 months, as a brilliant as an investor as Warren Buffett is, he's down 15% in the last 12 months. I mean, he's actually getting beat by the S&P, right? So that, if your portfolio's down, you've seen downward pressures. What I want you to understand is that Warren Buffett does not make emotional decisions. He makes calculated decisions. He understands why he is in the market. We're in the market for the long haul, that things will come and go. But I just wanted to share that with you because probably one of the greatest investors of our lifetime is actually down in this market. So just rest assured that this too shall pass, and that there are things you cannot be emotional here, because if he's not buying, then that means he doesn't see value yet either. And you could be selling at the wrong time if you have hopes to do so. So this chart here, I've been reviewing this to be able to present this, but I was fascinated because I've seen similar charts like this, but the detail to this warrants a little bit of time for me to spend of our 15 or 20 or 30 minutes that we have on the call today. I want you to help understand some things that I see, right? So this chart reflects a dollar. We're going back 150 years and you had $1 and you invested it into the market, and then all the way to the right, you see two values, right? You see the value to the right on top is 19,044, and that represents what the dollar would be worth at its market high just a few months ago, versus as of March 31st, the market is that dollar would be worth $15,303. But I think that when you look at things from a macro perspective, when you look at things and you take a step back and you look since history, that when we're going through this stuff, if you don't put things in perspective, under normal circumstances, this would barely be a blip in the market's history. But because we're going through it, it seems so magnificent. But I want to bring your attention to the left a little bit. We see that lost decade, even in comparison to what happened during the dot-com bubble burst in 2000. You can see that the market fell, and then it didn't quite get back to even. And then finally it got back to even, and we have the bull run to where we are now, right? That lost decade, right? So you say, hey, the market did correct, and then it recovered. Black Monday, that was when volatility started to appear, and people were like, oh my God, the sky is falling. But even now in hindsight, you look at it and go, although the market corrected, but it took time, but it did come back. But then we have inflation, Vietnam, and Watergate, and even that 10-year period, right, was a period of sideways channels, but it took a recovery. But then you see the 1929 crash and Great Depression, and notice that the market, I mean, that's the one that people still talk about, right? The Great Depression. Look at the fall off. And then it started to recover, got all the way there, and it crashed again. And then you turn around and we got all the way back, and it crashed again. That 15-year period is all pretty devastating in comparison to what we're going through now. But the one I wanted to draw your attention to is the one to the left of that, which is World War I and influenza. Out of everything that we've had in the past, that's probably one of the closest times in history to what we're going through right now. And even then, the influenza portion probably would have not been as significant. It was awful. But because we had a war going on during that time, right, we see that extended 10-year period until things got back to even. And the point that I wanted to point out here on this chart is that we have been through some tough times in this country, and we will get through this, but we are not nearly as bad as where we have been in other points in time. So if you think that you've missed the rally, that somehow April was this, and for the record, April is one of the all-time greatest months ever in history, not just in the last 10 years, in history. But you should not feel that we somehow missed it, because a lot of that was due to the infusion that the government has made and the steps that it's made. So that's why maybe when we're looking at what Warren has suggested, that we have to be patient, we have to not be emotional, and we have to understand that the market does not work in a V. There are very, if any, V's in there in a very short period of time that you can see. You can see that if the market does come down, it comes down over time, and then it comes back over time. And so not being reactionary is just prudent, and that's the message I wanted to convey here. I'm going to do a little bit deeper dive, because this chart here, it takes a little bit to explain, but I think once you start to look at what the market has done in the past, you'll start to put in context to what we're doing now. So when we look at this, right, this is right now the coronavirus in comparison to other significant downward market losses and recoveries that we saw on the slide before. But if you look all the way to the left, and it's, maybe if you got to get really close, but all the squigglies are all merged to the left, but there's one that's in red, right? The one that's in red is the coronavirus and what we're going through right now. And at the end of that, it says negative 22.5%. That's what we're going through right now. The legend at the top, right, tells you some of the other color codings, right? So in 1929, you had the dark blue line, right? We had the World War I and the influenza that I mentioned before, and the lost decade. But when you look at this, that again, it's not a V. None of these losses typically went straight down and straight back up. We have volatility, we have recoveries, but I do want you to see that typically, and I'll point to the Great Depression and World War II, which is the green line there. The green line, if you see, went down about 12.5%, and then it came back up to about 6%. So it's right there near all the way to the left. But then it dropped down to about 40%, and then it recovered about 20%. And at the end of this, I want you to see that all these lines have an end line where they got back to even. So the shortest being the dark blue line. That is the Great Depression. That one was actually able to get, completed a full cycle in 7 years, a little over 7 years. But even though it is one of the shortest periods in time with downward losses and recoveries, it's also one of the deepest. So I am not saying that we are heading towards a Great Depression. Right? Anything is further from the truth. There were so many different variables back then. They didn't have the restrictions and the mechanics in place on our banks or our financial institutions. The government didn't have the ability to do a stimulus package or help the economy out. And we were on a gold standard back then. I do point out, though, that the market, even though that it lost money on the way down, if you look almost every one of these charts, blue lines, yellow lines, green lines, that when they went down, there was a period where they recovered, that they went up 20 or 30% from the bottom. So to get back towards that break-even point. To focus on April as somehow being a missed or lost opportunity, I think might be a little too optimistic, right? That saying, hey, listen, I want to be all in the market right now because we're on a recovery. Because, these next slides that we're going to start to go through are eye-opening to me, which is why I wanted to share them. These reports were created by Morningstar, and they were created at the end of March. So April data wasn't available. And what they basically did is they said, look, we wanted to build out a model that said, look, what are new diagnoses in the thousands and the diagnosis rates and the new deaths and the fatality rate from now until the end of the year? And the projections to me, and what started to jump off the page here as I go through here, I absolutely feel needs to be shared so that we can make informed decisions. These are not doctors' opinions. This is just based on data. And then based on the data, it says, hey, listen, in a great scenario, what might the numbers look like? And in a bad scenario, what might the numbers look like? And then what's the median of that? So that's why we're calling this the base case, right? So a 50% probability. And then we're going to look at a bad case and what it could look like. And I'm just sharing this with you because if we look at these numbers on the top line, the new diagnoses, and what I found interesting is that because the data wasn't available in April, that the numbers were pretty close. So of new diagnoses, that number of 1,200, and then it went 1,200 for May, and then June you got 400, and then you got July, that's 100, and then that's August is 50. Those are thousands, so 100,000 or 50,000. But then start to watch what happens or is being projected to happen towards the end of the year. So this coincides with the summer months, right? So September, right, things start to creep back up. And then you have 12 million or 18 million, and then a little bit of a tail off towards the end of the year. So this is a model of a 50 percentile towards the end of the year. And then, obviously the diagnosis rate, the new deaths, and then the percentage of the fatality rate. So when you look at that and you go, okay, well, that's what's likely to happen from a physical standpoint and from a health standpoint. How does that affect the economy? So this here is then, if we were to use that information to be able to create a heat map, because at the left side of the column, you have two categories. You have mandatory closures and you have voluntary actions. So mandatory closures, well, we already know, like I said, I've been on lockdown here in New Jersey, 63 days, March and April, and we're now into May. Absolutely, sporting events. We've all experienced that. Concerts, just large gatherings or any place where you would be, and put a lot of people. They are projecting on a 50 percentile mandatory, right? That's 75%. That's dark blue across the top line closed. That's not happening this year. So from an industry standpoint, let's think about that, right? And how many football industry, hospitality industry, travel industry, we're all seeing it. So what does our common sense tell us? Is this likely and probable as a projection? Now, schools we already know, right? March, April, May, they've already been closed, but then it starts to soften. My wife works for Rutgers. There's talk of in June, maybe she's going to start to go back into the office. And so that's a little bit softer. And I point out that light color because there's not a lot of it on this chart. Restaurant and bars and all non-essential businesses. So getting back to normal is concerning, but if you have these mandatory closures and you have the government telling businesses that they have to close and cannot make a living, and even when they do reopen, will be at a 25 or 50% capacity, what effect does that have on the economy? And then voluntary actions, working from home, avoiding shopping. So how many people are ordering from Amazon and getting things delivered from Target or Walmart, right? And avoiding travel. Nobody wants to get sick, even though it's different parts of the country. People are going to handle this differently. But I think part of what we're going to see now is I'm going to take us to what happens if a bad case scenario and what could cause that. Well, this is the 30% probability, right? This is a bad scenario. This means what if the numbers happen quicker? Well, that means there's not a flattening of the curve, but actually the curve happens sooner. The numbers are greater, and they start to tail down. So what could cause that to happen? Well, let's think about what we know. What we know is that really some people, like I say, New York City being ground zero. So the cities that were hit hardest and the areas that were hit hardest were caused by a few people. And the governments have done a great job of putting this on lockdown. But now they're talking about lifting that. And if, and I'll take Los Angeles, California's governor, tens of millions of people have had very low exposure. I mean, the weather's warmer, but they absolutely clamped down. But we could see a shift where it only takes one person going through a new area to start this over. So let's say that the modeling is, people will always ask me, I want to see worst case scenario. Well, this is talking about a bad case. So now we look at the numbers, and we're talking 2.5 million in April, 6 million in May, 8 million in June, 7 million. So we have this sort of a higher diagnosis up front. But then what happens is something like a herd immunity. So we're almost starting to get it out of the way so we can move on, because authorities and experts are saying this is going to be with us for a while. So is this a better option? I don't know, but let's see what the economics say on this heat map. Now let's look at the purple across the top. Again, large events, absolutely out of the question for the rest of the year. So now you have entire industries that are in effect not only not doing business, but all the people that work for them. So what does this do to the economy, right? When people are not able to, A, have money to buy things, and B, to contribute to their company retirement plans, 401ks and IRAs and things like that. They're putting money away. They're actually might be liquidating some of those accounts, right, to be able to live on and pay their bills. So I don't know what the future is going to hold, but when you see schools now, if that were to happen, will we be comfortable right now knowing if there was a spike, sending our children to schools to that exposure? And then restaurants and bars. Now, again, look at if the government comes in and mandatorily closes these industries. You have a restaurant, right, that at 50%, or a bar, right, where you can only have 25% of your maximum capacity in the bar at any time. So if your bar was counting on 300 people and you're allowed to have 75, I'm here to tell you that a business owner across the country cannot survive. They might have weeks of cash right now, even with the stimulus package, not months, to survive. So what does that do to the economy? And then voluntary actions, right? Working from home. Now that's across the board. But notice that there's no light pink there. Like there was light blue in the other model. And again, that's the 50% model. So this is a worst case, just to have a heads up. And this is why not to have knee-jerk reactions in the market, because if we don't need the money now, I've had advisors call me and say, hey, maybe we should move to cash. If you could time the market, you would be Warren Buffett. Most of us aren't. We believe in having a risk-managed approach so that you have strategies in place to help you to be able to be in the market, participate in the market, and not be reactionary. So what happens next? Well, first thing is a historic rise in unemployment. This is, again, what I just want you to be aware of, and it's just data, but we have to understand that right now our unemployment rate, tens of millions of people have lost their job. That means tens of millions of people are not putting money into the economy. Now, how long is this? I don't know. I really do not know. But as much as the media would have you understand, things are all rosy and everything's happy and go lucky, I exercise caution. Let's not panic, but let's make sure that we have strategies in place to understand if things do correct further. Historic rise in unemployment, if we're at 16%, it is projected that we could be as high as 30%. 30% unemployment, the Great Depression had 25%. It could get ugly. And we have to make sure that we have plans in place to be able to ride the storm, because at the end of the day, we will recover from this. But then historic closures of small businesses, I think I've made my case there. I'm a small business owner. I deal with a lot of small business owners. I get it. I understand it, right? That you have to adapt and change. But different businesses are going to be affected differently, right? My business is different than the plumber. The plumber will always have leaky pipes and he might struggle, but that is not as, let's say, a restaurant. Somebody that was just starting out and said they had dreams of being an entrepreneur. And you know what? If nobody is going to the restaurant for whatever reason, they cannot afford the roof over their head. So they close. Now you have real estate investors, people that were counting on that income coming from those investment properties. That slows down. It all trickles down to these different areas. We need to go into it with our heads open. And then be cautious of the most interest rate sensitive investments. Because again, we are in a low interest rate environment and it's not changing anytime in the next 10 years. So if you're buying bond portfolios, think about it. Where is people's flight to safety? Normally they're in equities, right? But we've talked about the equity market and the risk that's involved. And yes, we can lose money. Well, let's talk about what was traditionally safe money. Right? If you're in high yield municipal bonds, government bonds, and governments start feeling pressure, do you think you can't lose money in bonds? The answer is absolutely you can lose money in bonds. If you bought a bond today, it might be yielding 2% or 3%, right? So if you're buying bonds and you bought a bond at 6%, would you ever want to step in and buy a bond today? But those bonds have come due. So as this money is being recycled through the economy, you will see bond portfolios, mutual funds that owned a large portion of bonds. And I don't care whether you're in muni bonds or government or corporate bonds, that they are subject to market risk. And so in bonds, I've been saying this for a couple of years, do not like rising interest rates. So right now they're flat. So they're not rising. Where you could see a bad day for the bond market is if we head into an inflationary environment because things get expensive. So just understand, having, again, a risk-managed approach to your investment is very important. And then human behavior will change. We are all adapting. We are all learning how to function. Listen, I love my family and I want to spend as much time with them, but I have extended family. I'd like to see them too. And it's really hard right now. But at the end of the day, we're all in this together and we're having to make adjustments along the way. Warren Buffett, this is the one thing that I take away, and I want to sort of wrap it up with this because he absolutely nailed it. Perhaps with a bias, I don't believe anyone knows what the market is going to do tomorrow, next week, next month, or next year. I know America is going to move forward over time, but I don't know for sure, and we learned this on September 10th, 2001. And we learned it a few months ago in terms of the virus. Anything can happen in terms of the markets. And you can bet on America, but you're going to have to be careful how you bet, simply because markets can do anything. And here's how I read that. Warren Buffett is going to bet on America. I'm going to bet on America. I believe that, I'm very cautious about the global investment in emerging markets in other parts of the country, but right now, there are places that are doing well, right? And you can be with strategies in the market smartly. So overall, I just wanted to share with you, this is my take. I think that the market is going to have continued volatility and pressure, and that as we enter into the market, we should take, if you're not in the market yet or you're thinking of creating a new strategy, you should do so with a strategy. But selling and getting out of the market and sitting on the sideline, that's already been proven to be a bad idea. Riding it down if it goes down, and then, hey, hope is not a plan. But having strategies that can refuel your investments if that happens is a good fundamental basic. So I like an income portfolio. Depending on where you are in your ability to retire, if you're 10 years from retirement, you should be looking for income generating revenue. If you're 20 or 30, you can start to look for growth and maybe some value. So different strategies depending on your needs and your goals. I do want to just reassure you that I think that looking closer to home in American-based vehicles versus some of the global economy would be a prudent step long term. So what do we do now? Do not make emotional decisions. Talk to the person that invited you on this call. Talk to your advisor. Reach out to me. That's part of a good advisor's job. We're in this together. It's okay to be balanced or even conservative right now. You can make plan adjustments. So ways we can help, update your financial plans, right? If you haven't put your financial plan together lately, let's review. Provide timely market and portfolio update. This is the part where if you're thinking of making adjustments, do so with a strategy. And then I want to thank you. I want to thank everybody on this call. Also, I have to put my disclosure up. I'm not giving any investment advice. These are just my opinions. So past performance does not guarantee future results. And then if you were invited here by the advisor on this call, I just want to encourage you, get back with them, sit with a professional. You don't have to do this alone. So guys, I want to thank everybody on the call. Stay well. If you need me, I'm a phone call away.